Hello there. Welcome to Commodities. Let's see how the energy complex is doing right now. There's more talk that Ukraine and Russia may be moving closer to an agreement of some sort to end the violence in Ukraine. ABC News, CBS, both reporting that a U.S. official said Ukraine had agreed on the terms of a potential pact. Meanwhile, Reuters says it talked to a Ukrainian official who said that the Ukrainian government supports the essence of a framework for peace, but some of the most sensitive issues remain to be discussed. Meanwhile, Deutsche Bank is warning it sees a crude oil surplus next year of at least 2 million barrels a day. That again from Reuters. And no clear path back to a balanced market, or at least deficits, even by 2027. So warning that as we move into 2026, the outlook looks bearish amid ample oil supply. But of course, if sanctions were to be removed on Russia, that too would be bearish. It would bring so much Russian crude back onto the world market. There is gold, and it's moving higher. Bloomberg reported that the White House National Economic Council Director, Kevin Hassett, is seen possibly as the next head of the Federal Reserve. And he is a close ally of U.S. President Donald Trump and would be seen as backing Trump's predilection for lower interest rates. Lower interest rates generally seen as good for gold. And let's have a look at the agricultural commodities. And you can see wheat is up. You would think, well, an end to the war in Ukraine would be bearish for wheat, would tend to bring more supplies onto the market. However, even though initially after Russia attacked Ukraine, ships were blocked from lifting cargoes, however, Kiev managed to get more supply onto global markets after a while, and Russian crop exports weren't even subject to sanctions. They continued to ship out their grains. So Bloomberg arguing that this probably won't be a huge, if there is a peace deal, probably won't be a huge deal in the near term for agricultural markets. Of course, it could help Ukraine in the sense that its railway network has been damaged by Russia. It would be easier for the Ukrainians to move grain exports. And there could be implications for the fertilizer industry, companies such as Nutrien, if this means more Russian and Belarusian fertilizer coming on the market. Let's get to the other commodity-related stories we're bringing you today. There are reports that the federal government and Alberta have agreed to terms of a deal to support a new pipeline to the West Coast. Apparently, federal and provincial leaders are expecting to make an announcement on Thursday. This will include some kind of special exemptions for a pipeline project. The BC Premier, David Eby, has expressed opposition. He says he wants any potential deal between Alberta or Ottawa to include a cap or a ban on the use of taxpayers' dollars to build a pipeline. Bloomberg says Barrick Mining agreed to pay $430 million US to the government of Mali in West Africa to settle the dispute over Barrick's giant mine in that country. I love that picture. It makes the trucks look like toys. The scale of that mine. According to the report, Barrick will pay about $250 million within 6 days of signing the deal, and the remaining amount via credit offsets. And Barrick will, under the deal, regain operational control over the mine. We had this week news that Australian mining group BHP is abandoning its most recent attempt to take over Anglo American. And this apparently gives a green light to Anglo American's plan to buy Vancouver-based Teck Resources. Our guest, though, says that latter merger still faces challenges. We're joined by Maximilian Hess, principal at Enmatana Advisory and a fellow at the Foreign Policy Research Institute. Maximilian, thank you very much indeed for joining us.
Thank you for having me.
So BHP took another run at Anglo, maybe not surprising because Anglo has valuable copper assets.
Yes, well, the copper assets are really what's at question here and what has been driving a lot of M&A activity. This comes as Anglo American itself is making a bid for Canada's Teck resources, primarily interested in their joint copper tie-ups in Chile in particular. And this is really driven by geopolitical trends in much the same way, just very different ones to Russia and Ukraine, but ones coming out of the increased interest in trying to control supply chains and commodity markets, given copper's use in AI and the renewables agenda.
But you say that the Anglo-American Teck deal isn't a certainty. For one thing, the Canadian federal government says it's imposing tougher terms than have so far been proposed.
Well, that's exactly it. The Anglo-American deal has faced challenges. There are questions over its plans for its future headquarters, but whether it will keep its listing in London or move that to Canada, something that the Canadian government has reportedly been pushing for. So that tie-up is by no means set to go ahead. It faces a key shareholder vote in the coming weeks, but the regulatory challenges will hang over it as well. That copper demand, though, seems to be fairly strong. We see it in a number of other metals driving similar trends, but I think that one of the challenges here is that initially BHP had made a bid that was contingent on divesting some of Anglo American's assets, and it does face challenges in doing so with whether it be its coal portfolio, its diamond mines in Botswana, which it's been moving to sell and have been the subject of a lot of geopolitical questions, or even its key fertilizer mine here in the UK that has faced a number of challenges.
Sorry, you're talking about BHP there.
Sorry, no, about Anglo-American.
Anglo-American, yeah, I wanted to clarify that. Yeah, so I didn't know Anglo-American involved in a fertilizer project in Britain?
Yes.
That's interesting. Yeah, I hadn't heard about that one. If the Canadian government was to veto this deal, this takeover by Anglo-American, do you think it would send an unfortunate signal to the world business community, about Canada being protectionist or arbitrary in its governance?
Well, protectionism is really gaining a lot of traction in a number of governments around the world, of course, in the United States as well. So there are key questions that Ottawa has to look at itself and decide how it wants to regulate its own mining industry going forward. Of course, Teck being one of the last very large Canadian domestic firms, but Canada playing a very large role in the global mining industry through listings there. So there's a number of geopolitical questions that certainly Canada faces, and that's why it's been subject to so much regulatory scrutiny.
It's interesting. I mean, prior to Mr. Trump's current incumbency, you'd think, and really the emergence of economic nationalism, protectionism, you might have thought, well, Canada would be wary of taking a strong stance like that. But it seems like the rules have changed now, and countries are expected to stand up for domestic industries.
Yes, I certainly think that that's something we're seeing in the mining sector as well as in the tech sector. The EU has recently been in its own fights with Chinese chip-making companies. Protectionism is a global trend at this stage.
What do you think, will this, assume the Anglo-American takeover of Teck goes ahead and they finesse something, although it's interesting, sorry, just to return to that, it sounds like Anglo-American is determined not to have its actual domicile moved to Canada. They want to stay principally listed on the London Exchange.
Yes, there are big regulatory differences and enforcement differences depending on where that listing is. My understanding is the Canadian government has pushed for that listing to be moved to Canada. That is one of the key regulatory questions that really hangs over this deal, certainly.
Yeah, they would have a listing in Toronto, but as you know, it wouldn't be the primary listing as currently proposed. Do you think we will see a rush now, a land rush to try to acquire copper assets by other companies?
I certainly think that what the ultimate outcome of Anglo-American's future is, whether this Teck tie-up goes ahead or whether it does not, will trigger further reverberations in the industry and potentially appetite for assets, yes.
And isn't it interesting, just taking a long view, for decades, it looked like countries weren't really concerned about where their metals were processed. I think the feeling was, well, intellectual property is the important thing. Who cares who smelts the metal? But it's a very different tone these days.
Certainly it is. We've seen metal tariffs be at the top of the Trump agenda. We see demand for AI data centers and the power needed for them, which is a very copper-heavy industry. That's really helped boost the price a lot in recent months. Questions about where those will be based and the geopolitical regulations that come down over them. And that's trickled down into the supply chain, whether it be at the chip level from a few years ago or now increasingly at the raw commodity level, and not just rare earth minerals, but major metals as well.
We'd better jump. Maximilian, thank you very much.
Thank you for having me.
Maximilian Hess, principal at Enmetana Advisory and a fellow at the Foreign Policy Research Institute. Up next, oil under pressure after Ukraine reportedly agreed to the outline of a peace deal. We'll have more after this. The price of oil under pressure today. There are suggestions, multiple reports, that Ukraine is tentatively agreeing to the outline of a potential U.S. brokered peace deal. Let's get more from Jason Shankar, president of Prestige Economics. Jason, thanks very much indeed for joining us. Your feeling, and I think you've said this before, is that ultimately the settlement here will be a partitioned Ukraine along the lines of Korea in the deal that ended the Korean War.
Yeah, that's right, Andy. Thanks for having me on. It's been a while since we've joined each other. I think I've been writing since March of 2022, since shortly after the Russian war on Ukraine started, that the most likely outcome would be a country divided, a begrudged armistice, a demilitarized zone, and a country that might be this way, right, sort of torn apart for the better part of this century. And that does seem to be what we're moving towards. And although it seems like there is progress and that there's a willingness on the side of the Ukrainians to move this along, the question is, are the Russians willing to move things along? It takes two to tango, as it were. And the question is, do we actually see movement? Are we closer to a negotiated agreement? Yes, but there's still quite a bit left to the runway here.
So the worry here, of course, will be that Putin will come back and just take another bite. America, Western Europe may offer Ukraine guarantees, but the Ukrainians could say, well, we heard that before when we gave up the nuclear weapons after the Soviet Union collapsed.
I think that's right. There are a couple of pieces here. I think the proximate risk is that maybe Putin says he's not really interested in these terms, and the terms he wants are far more expansive than what's in there, right? I mean, Russia's been pushing for these maximalist demands to gain maximum control over territory in Ukraine. Is this something that is that golden bridge you can build for Putin to cross that kind of ends the war? Is that enough? And so I think that's the proximate question. But you're right, in the medium term, are we sure that peace can hold? And I know there are certain planks in there that allow for various kinds of weapons in support of Ukraine that would hopefully provide the disincentive towards additional future conflict, provide effective conflict deterrence. But those are also things that might keep Putin from wanting to push this agreement forward as well.
Can we just broaden our scope here? You came out with a book this year called Cold War II, and obviously China, a big part of that as well. What are the implications for commodities, do you think, in years to come with this power tussle between Russia and America, but more especially between America and China?
There's two sides of it. On the one side, you see with Russia over Ukraine, because Russia is such a big producer of so many different commodities. When the Russian war on Ukraine happened, we saw these massive spikes in commodity prices, which engendered all kinds of inflation globally. Now, as we see the potential for some kind of an armistice, a negotiated agreement, you see oil prices under pressure. Why? Because, well, then you'd expect that these commodities will more broadly enter various markets, right? We suddenly would get more access to Russian oil, Russian aluminum, Russian nickel, and many other materials. So we could see commodity prices come down there. The risk between the U.S. and China are that if China has an undeterred ambition to gain control of Taiwan, and 2027 is the year that's been floated that's the year she wants China to be able to take control of Taiwan because it's the 100th anniversary of the People's Liberation Army. If that happens, then you could end up with overnight economic amputation of a different stripe, where suddenly you just can't. Canadians, Americans, many other countries will probably no longer be able to get any goods from China. And there would be questions about what goods we could get from Taiwan. And of course, China's a big net importer of commodities. That would be a different question. If suddenly those commodity flows stop, that could also prove bearish. But for finished goods, that could be inflationary.
And then, of course, there's the question of chips from Taiwan. It would there'd be a threat of paralyzing the whole tech industry as a whole.
Absolutely. That's the risk. That's why we see a lot of U.S. strategies. I know we've talked about throughout this year, a lot of the U.S. policies around trade and tariffs are to focus on transshipments to try to engage in economic containment, provide economic pressures and effective deterrence to prevent China from making a grab for Taiwan in 2027, to try to improve U.S. economic self-sufficiency, to bolster our status as a credible threat, to reduce that ability of China to think about taking Taiwan. Because if we were to lose access to China, that's bad, right? If China gets cut off from the global economy, bad for China, bad for the global economy. If Taiwan gets cut off in the process, right? China blockades Taiwan, as they did multiple times last year, both in May and October, in Operations Joint Sword 2025A and 2024A and 2024B. If they were to do a permanent blockade, we could find economic amputation not only for just China, but also Taiwan, where then we can't get the chips and we can't get all kinds of other ICT industry goods that we need for our economies. So these are really big risks. And then, of course, in Asia, there's contagion risk, right? This is something that the Republic of Korea and Japan are very concerned about. So these are all very much moving pieces, but if we can get this one front of Cold War II to calm down, then we can shift our attention potentially a bit more to providing more credible threats, more effective deterrents to prevent kinetic war with China, to provide those disincentives to avoid a war over Taiwan.
And just backing back to Russia and Ukraine, you do, and Jason, you may have touched on this, but oil, if it gets a blow here because there's a peace deal and sanctions come off Russia, you say that's just adding to an already bearish backdrop for crude?
Well, I think that right now we do see crude's under pressure because there is so much global uncertainty. I think we would see prices come under pressure now. I do think prices will likely be a bit higher next year because we have seen some interest rate cuts. We'll likely see more cuts ahead. Lower interest rates are things that should support, and many central banks around the world have been cutting rates. We are likely to see increased demand next year, but we could see some short-term significant downward pressure once a peace deal is announced. But if that provides economic optimism, then you could get more demand next year. And oil's not going to go bad. It will still be consumed at some point. And the question is, are we continuing to build global growth? And if we look at the IMF figures, global GDP is expected to be above 3% this year and next year. And if that growth rate kind of continues going forward, you're looking at more oil demand in the future. And that will be fundamentally supportive, even if in the short term there's downside price risk.
Jason, thanks very much indeed. Jason Schenker, president of Prestige Economics. U.S. President Donald Trump is on a campaign to bring down beef prices, but a crisis in U.S. cattle supply is making that goal tough. We're going to have more next. Let's take another quick look at commodities. And we'll start off with oil once again. Pressure on oil. Let's put up a 5-year chart for oil because it's been, look at that, down almost 20% in the past 12 months. Or even if we go with a 10-year chart, for oil. Oh, we don't have that right now. The interesting thing here is that the economy in the U.S. taking over, China not booming, but certainly doing okay. They haven't resolved questions about debt in their construction sector yet. Meanwhile, though, electric vehicles eating up an ever bigger market share in China. And let's have a look at copper, because we haven't talked that much about copper. We did touch on it when we discussed BHP abandoning another attempt to buy Anglo American. There is copper distorted by US President Donald Trump's tariffs that caused that huge run up this summer, and then a tanking after it turned out only some copper products would be subject to levies. So copper trading not far off record highs when you exclude that artificial run up during the summer. And let's have a look at gold. Gold doing well today on the prospect of a Trump ally becoming chairman of the U.S. Federal Reserve. And you can see copper still down from its records, but moving up not far short of 4,200 today. Let's have a look now at soybeans, because we should have got into this with Jason Schenker. Can't cover everything. But soybeans, U.S. soybean prices have been depressed over the past year by the fact that China has been rejecting U.S. soybean imports. However, soy has begun to rally lately on signs that the Chinese are taking soybeans. Obviously, the whole thing is a to and fro, and soybeans have become a bargaining counter between Washington and Beijing. The broader battle, of course, on the economic front is who's going to be the dominant force in global technology. And let's have a look at wheat, because wheat, Russia is a dominant player in the global wheat export sector. It was never sanctioned, though. It's like, it's interesting how the West didn't apply sanctions on things that weren't convenient. I'm being a bit cynical there. If wheat prices had soared, it would have been a major problem for countries such as Egypt that rely on huge quantities of imported wheat to supply their populations. However, of course, America didn't reject Russian Ukrainium. Still a lot of Russian Ukrainium. Uranium. There's no such thing. Uranium. A lot of Russian nuclear fuel still being used in American nuclear reactors. Let's have a look now at natural gas in the United States. Looks like we're going to have difficulty bringing you that beef segment today. Try to get to it tomorrow or Thursday. There is natural gas, and it's been rallying lately in the United States, but still vast quantities of the shale fields in the United States, they've been burning it off or giving it away, rather similar to Canada, just excess natural gas. So it is logical economically that both Canada and the US are building out these LNG export terminals. But natural gas rallying sharply lately. Thanks very much for watching Commodities. We got the close up next with Mirella Fernandez.